Hey folks, and welcome back to the Mortgage Farmer. It is early January 2025. Happy New Year. I've had some clients, some customers, realtors asking me, what do we make of what's going on with the economy? What do we make of mortgage rates? Why did mortgage rates fall and then rise back up again? Why did the federal funds rate go down at the December meeting, but mortgage rates went up anyway? There's all kinds of questions going on there. And what we're going to do here is take a quick look into what's driving it, what causes it, what are the things that the Federal Open Market Committee looks at in determining if they should raise or lower the federal funds rate, and how does that impact you as a consumer on a daily basis. Stick with me as we go through some of those things and we just talk about what it is that's going on and how you can be prepared financially for 2025. So, what are the things that drive mortgage rates? More importantly, to you, the consumer, to our customers, to those people out there that are looking to potentially buy houses, what are the things that you can look at, economically speaking, that will help you better understand what's going on? Well, first and foremost, it's difficult to better understand something that no one understands to begin with. I say that somewhat tongue-in-cheek. There are things that we can do to learn from it, and I have done that over my 30-plus years of being in this industry. It helps us to understand what someone else is thinking. So what we're doing here is we're looking at a Federal Open Market Committee that is focusing on small tweaks so that they can manipulate our free market economy. Now, I use those air quotes, and you've seen in other videos that I've made comments like that. I wish they would just leave it alone. I realize they can't. I realize that anything this big sometimes needs gentle nudges, and as long as it's only a small gentle nudge and not an obvious attempt to change course completely, I'm okay with that. What they did in December it kind of set us back from what they did in September. In other words, in September, when they lowered the federal funds rate by 0.5%, or what you might hear called 50 basis points, the markets liked that. Here we go. We're off and running. We are set towards a path where we can begin to see an easing of monetary policy restrictions, and they're going to let the economy kind of come back down a little bit and allow us to enjoy some of that. Then they followed that up with another reduction in November, and here we go. So now we've got a 75 basis points reduction so far in the year, and we're headed in the right direction. Then in December, they did it again. Yay! Not really. What happened in December was not only did they lower it by 25 basis points, 0.25%, which carried us to a full 1% or 100 basis point reduction in fiscal year 2024, but they couldn't stop there. They decided to speak out and say, basically, yes, we just lowered rates by 0.25%, but that's all you're going to get for a while. Now, they have basically said there's a good chance that we will see a 0.25% reduction in January of 2025, but that's it for now. Even though they're doing those small movements to manipulate the economy to help keep it in a certain track, they kind of defeated the purpose when they made those statements afterward, because mortgage rates are not driven directly by what the Federal Reserve and the Federal Open Market Committee do. They're not driven by that. Mortgage rates are driven by the mortgage-backed securities markets, just like you buy and sell stocks and bonds or mutual funds, and there are exchanges that you go and you trade back and forth, and we follow the Dow Jones and we follow some of those other indices, those things as well. We're not going to talk about that today. We're talking about mortgages. Mortgages are directly controlled by the mortgage-backed securities market, and those securities are bought and sold. But there is a finite amount of investment dollars that are out there from the large corporations, the insurance companies, the giant 401k providers and places like that. They have large amounts of money to invest, but they have a finite amount. And, some will put it in the stock market or stocks and bonds. Others look for more secure places like treasury bills. Well, mortgage-backed securities are in that competition, and they're fighting for that as well. So generally speaking, when the stock market is doing really well, mortgage-backed securities are not doing as well, meaning, as I refer to rates, mortgage-backed securities increasing their yields is good for those people that have invested in those mortgage-backed securities, but increasing those yields is going to mean that rates on mortgages have to go up. So they work inverse. Almost every time when the stock market is doing well, mortgage-backed securities are not. Or if the stock market is doing poorly, mortgage-backed securities are doing well. Seldom do they move together. Usually it's opposite of each other. But at that December meeting, stocks and mortgage-backed securities both moved the same way, and that was the stock market was banking on this easing of monetary policy and the lowering of rates so that the economy could get going again. But when they made that comment that they're going to stop doing that, then you're dealing with banks and financial institutions. Well, their revenues, their profits are directly tied to rates of return, not only on the investments that they hold from their customers, but also the investments they make in the form of lending out money, whether it be to you or me in a credit card, or whether it be to some large financial entity that needs to borrow, $1 billion or something like that. Those things, they all flow. Well, let's look at kind of what's going on. I'm going to put up on the screen right now some numbers that I want you to pay attention to. In December, we received the unemployment rate, and it came in at 4.2%. That was an increase from the September and October numbers of 4.1%. Furthermore, the job creation numbers for November came in at 227,000. Now, what I'm getting at here is this number, this November jobs report number, is probably a big reason that the Federal Reserve pulled back in their comments in December. They were expecting a lower number in jobs created, and they got more jobs created. At least the initial report, they got more jobs created. Taking a step back, the same time that they announced the November jobs report, they revised August and September, and the August and September numbers, so August was 142,000, September was 254,000, but they revised the two of those together down to 284. In previous videos, I've given you information about that, and I've explained how that happens on a regular basis. They revise them down, and I wonder what they will do in November. The December jobs report is coming out any minute. Any time now, we're going to get the December jobs report, and that will go a long ways towards firming up what happens in January at the Fed meeting at the end of the month, and furthermore, what will happen moving forward into fiscal 2025. The Fed has stated that for now, they believe they are in a good target range for the federal funds rate of between 4.25 and 4.5. That's something that we all would want to pay attention to. Furthermore, with those jobs numbers that we are looking out for right now, another thing that we want to pay attention to is the prime lending rate. And the reason that's important is because that prime lending rate goes a long ways towards determining things like the rates you pay on your credit card, the rates you pay for car loans, the rate that you would pay on your home equity line of credit that you may have against your home. In July of 2023, it was raised from 8.25 to 8.5. By the way, that was the last increase that the Federal Open Market Committee made. They also raised the federal funds rate at that time by 0.25% to 5.5%. Now, it is every time the Fed has reduced rates, the prime has come down, so we are now at 7.5%, down from that high of 8.5%. Those are things that we want to pay attention to. All of those things will have some level of impact on us in what we're doing. So I hope this gives you a little insight as to what's going on. We are watching cautiously with what comes out in the jobs report that's coming out immediately. We will also look to see if there is a November revision to that jobs report so that we'll see where we're headed there. I hope that helps you just a little bit, giving you an eye. It's funny, in September when they lowered rates by 0.5%, the mortgage-backed securities market loved it. They also loved what they said immediately following that meeting, and it sounded like we were headed down a path of continued small reductions over time. We would see rates begin to normalize and come off that 7% number that we were at in September. We dropped down and mortgage rates actually took a pretty good dip. And then no sooner than that happened, rates began to creep back up again because economic numbers came out and the Fed began speaking. Then once again, they lowered rates in November. Yay. They lowered rates in December. Yay. But they opened their mouth and then rates went right back up again, and we're kind of back where we started there. We do believe that we should see some normalizing of rates in 2025. What does that mean to you, the consumer? If you have a mortgage loan now and you've obtained that mortgage loan in the last, say, 14, 15 months, you want to pay attention because opportunities to refinance that to a slightly lower interest rate might be available as we come into the spring. If you're a first-time buyer and you are either ready right now or you've been ready but you've been sitting on the sidelines because you wanted those rates to come down, now is the time to find your trusted mortgage professional. Whether it's me, the mortgage farmer here in Cary, North Carolina, or your personal preferred mortgage professional, meet with a mortgage professional. Get your ducks in a row and prepare yourself and put yourself in those planning stages so that you have a plan on what you want to do. I can't tell you if right now is the right time for you to buy or whether you should wait to see if rates fall. I can give you historical data. By the way, historical data always supports buying as soon as you're financially able to buy, as opposed to the alternative. But that doesn't mean that this won't be the exception, and every case is different. And all I will say to you is you need to prepare and put a plan in place for your situation because every situation is different. I would love to help you with that. I hope you've enjoyed this video. Please hit that subscribe button. Please hit that like button. We grow this channel by that. I've said many times, don't take me too seriously. I don't take myself that seriously. I hope this information helped you a little bit. Again, jobs reports should come out sometime in this first full week of January 7, 8, 9, 10, somewhere right in there. We are waiting to see what will happen at the end of January with the Federal Open Market Committee. Jobs improved in November and they saw that and we're like, oh, maybe we ought to pull back. Unemployment went up during that time period, meaning fewer people were being able to find a job. That's not good. That might mean that the economy needs a little help. We need to ease the burden on large corporations so that they may go and hire more workers. All of those things matter. Thanks again for watching. I really appreciate your time here. Come back and join us next time right here on The Mortgage Farmer.